China has experienced the most vigorous economic growth in human history. In just 4 short decades, the country has transformed from a poverty-stricken hinterland struggling for survival to a nation adorned with glittering skyscrapers and more Gucci stores than one can count. The driving force behind this growth was evidently the embrace of the free market and openness to international trade. China has always had immense potential, as, in 1900, within the last 2,000 years, it was the world's largest economy. Now, despite some challenges, it is fully realizing this potential. Given this growth, people are naturally eager to jump on the bandwagon. Millions have earned millions of dollars, and any sensible investor would be foolish not to participate in the world's largest growth market. I spend a lot of time talking to people interested in economics and finance, and one of the most common questions I hear is, how can I invest in Chinese stocks? I don't want to sound impolite, and I promise to phrase this as kindly as possible, but if someone has to ask on YouTube how to invest in Chinese stocks, they should definitely not invest in Chinese stocks. Even for experienced investors, the Chinese market for companies is not exactly the promised land with double-digit annual returns, as some might think. Let's break down why the Chinese stock market is both excessively and insufficiently regulated. It may sound absurd, but let's examine this problem step by step. In what ways is the Chinese stock market overregulated? How is it underregulated? And why does this mean that most investors probably should not venture into these markets? Firstly, it's essential to note that stock exchanges worldwide are mostly not state-owned entities. For instance, the New York Stock Exchange, the largest in the world, is a regular company, comparable in many ways to eBay. However, it deals with the exchange of stocks of publicly traded companies rather than unwanted Christmas gifts. While entities like the NYSE strive to look like government institutions, adorned with American flags in historic buildings reminiscent of Washington, D.C., they are not government agencies but regular companies. The Chinese market, surprisingly, simplifies this process. China has 2 dominant exchanges, the Shanghai Stock Exchange and the Shenzhen Stock Exchange. These markets parallel the New York Stock Exchange and Nasdaq, with one being more extensive but listing more established industry players, while the other is smaller but lists more emerging companies, especially in technology. It's worth noting that the Shenzhen Stock Exchange is geographically and financially very close to the Hong Kong Stock Exchange. The significant difference is that these Chinese exchanges are government-owned. The Shanghai Stock Exchange is a government agency, similar to the tax authority or the military. As China is theoretically a communist state, the government views stock trading as a public task. This leads to a couple of crucial problems. Firstly, the government controls which companies go public and which do not. In a perfectly fair and unbiased system, this might not be an issue. However, in this specific market, it could pose a problem. Another issue is the difficulty in overcoming entry barriers. There is an extensive list of requirements for a company to be listed on the stock exchange, beyond the usual requirements for a private company. To meet these criteria, companies going public typically enlist the help of an investment bank, which ensures a smooth process and takes over the business if things go south. In China, this dynamic is different. The government finances the exchanges, so if a company fails to go public or takes an extended period to do so, it's not a problem. The same restrictions apply even when a company successfully goes public. The rules regarding ownership structures, reporting standards, and who can buy shares are highly limited. For instance, foreign investors cannot directly purchase shares without undergoing a comprehensive review. Even if approved, their selection is restricted. Suppose, as a German citizen, I want to invest directly in an American company. That's no problem, I simply instruct my broker to buy shares of Apple, Amazon, or Bank of America. This process is just as easy, if not easier, than buying stocks on a German exchange. However, if I wanted to buy shares on the Shanghai Stock Exchange, it's an entirely different story. It's highly likely that 99% of you wouldn't qualify, as you must meet specific criteria. You need a permanent residence permit for China, be an employee of a publicly traded company participating in the company's stock incentives, foreign executives receiving stock options, work in China, or be the owner of a company operating globally and in China. Even if you meet these criteria, you must undergo a rigorous background check and can only purchase non-voting shares in the companies. While you'll benefit from profits and appreciation, you won't have a say in company decisions or board votes. China is keen on avoiding foreign influence in its major companies. Given these stringent restrictions, these exchanges are not ideal for raising capital, which is essentially the primary purpose of a stock exchange. Consequently, the largest publicly traded companies are mostly state-owned, with about 10% of equity held by the public. As these companies have additional goals beyond pure profit-making, their performance is not as remarkable as one would expect from a nation experiencing such rapid growth. It's crucial to emphasize that the stock market is not synonymous with the economy. In China, the relationship is often the opposite of what is observed in Western economies. This is why most Chinese investors allocate less to the stock market compared to their Western counterparts, preferring real estate investments. While these considerations are essential, they are better suited for another video. Interestingly, China's overregulation has led to a significant issue of underregulation. Companies require funding for growth, expansion, research, and development. This necessity gave rise to stock exchanges, as, before stocks, investing in a company meant becoming a shareholder, entailing liability for the company's problems. In China, as elsewhere, many companies need capital for expansion but struggle to list on the local stock exchange. The logical alternative is to list on a different exchange. In the past, Hong Kong was a popular choice due to its proximity to the mainland and its status as a separate economic entity. However, as regional boundaries blur, more companies are turning to international exchanges, such as the New York Stock Exchange, actively encouraging their participation. The NYSE, being a for-profit company seeking listings to generate revenue, offers an attractive proposition. This shift presents challenges for potential investors. Companies engaged in such maneuvers could potentially present falsified books or financial figures, posing a significant problem for investors. The stock listing process of an exchange aims to prevent misinformation, with both the exchange and the companies going public liable for false information in offerings. However, there's a sophisticated loophole for potentially dishonest companies. In a reverse merger, a private, non-publicly traded company takes control of a publicly traded company and merges with it to form a large publicly traded entity. In this scenario, a dubious businessman seeking to capitalize on the Chinese growth hype would establish a company in China, conducting any business or none at all. Authenticity doesn't matter. The crucial aspect is making the warehouse and website appear genuine. Subsequently, the businessman's accountant creates reports suggesting the company has significant revenues and profits. The next step involves finding a publicly traded company on an exchange from which the businessman intends to benefit, such as the New York Stock Exchange. Ideally, this would be a small company with a low market capitalization, perhaps an old, struggling entity in an irrelevant industry. Let's call it Dunder Mifflin. Some companies like Dunder Mifflin may have a market capitalization of only $25 million, which is substantial but sufficient for a questionable businessman. To complete the merger, the businessman merely needs a majority stake. 51% is enough. Once the acquisition is finalized, the two companies merge into a new entity that continues trading on the NYSE. At this point, the previous public company can be entirely dissolved, selling everything it owned to recoup a portion of the $25 million, depending on its assets. After this process, the company can change its name to resemble a Chinese company. Let's just call it a definitely existing Chinese company. This enables the businessman to offer new investors a direct entry into an emerging Chinese company without the hassle of investing through the Shanghai Stock Exchange. While some investors may remain skeptical, it's acceptable. The businessman can pay a public figure, like Bill Clinton, to speak about the Chinese market's growth, creating a buzz that attracts unsuspecting investors. Now is the time to capitalize on this opportunity. There are two ways to achieve this. The first involves using the entire invested capital to pay oneself a high salary as CEO or to pay another company one owns as consulting fees. The second option is to sell one's own shares on the stock exchange once they have experienced a significant increase in value. A shrewd businessman typically employs a combination of both strategies. One might wonder if this is legal. Yes, it is undoubtedly illegal. However, individuals engaging in such activities usually have connections that shield them from legal consequences. Sounds great, doesn't it? Now, you might be asking, where do I begin? There are several ways to invest in Chinese companies. The riskiest, but logically the most direct, is to engage in business with a partner in China. Another method is to purchase shares in companies listed on exchanges outside the Chinese mainland. Companies like Alibaba, Tencent, or Xiaomi are all listed on international exchanges for broader funding. Lastly, investors can gain access to stocks exclusively traded on Chinese exchanges through exchange-traded funds, ETFs, or mutual funds. These financial instruments essentially involve buying a security, which, in turn, purchases shares in companies approved by the Chinese government for listing on these exchanges. BlackRock's iShares offers such opportunities, with the MSCI China ETF, MCHA, being one example. There are many others, but a word of caution, China has experienced remarkable growth, and it will likely continue to grow despite its problems. However, the performance of these indices has been good but not as overwhelming as one would expect given the overall economic growth. Thank you for watching, and take care, everyone.